Thank you very much and good afternoon to everyone. Thanks for the invite. And I will try to be brief in the build up to my case because we have already talked about many of these topics. So what is the Nat Cat protection gap? The difference between total economic and total insured losses. We already heard in the morning that this has amounted to 1.3 billion over the past 10 years. In the case of the Nepal quake, 4.8 billion out of the 5 billion of total economic losses went uninsured, 4.8 out of 5. The Thai floods, 30 billion out of 46. And these are two cases which we could call from the not so developed economies. But when we look at the insurance penetration in a market like California, the pickup rate for earthquake insurance in California is below 10%. We haven't had a big earthquake in California over the past few years, and therefore I cannot give you the figures that would stand behind my claim that probably the gap is larger in some of the developed economies than in many of the less developed spaces. From a model perspective, the annual uninsured expected losses are 153 billion per annum according to our model, with Europe contributing 8.1 billion of annual expected loss uninsured for earthquake, 5.7 for flood, and 1.2 for wind. Where does the protection gap sit? The protection gap stands both with individuals and corporates. Things that are owned, simple. Most of us own certain part of our things, and most of us owe certain part of our things. And we owe most of us to certain money lenders, right? So to a certain degree, our money lenders also have part of our risk if we don't have it protected. But in the end, the public sector, beyond the things that they own, they are also expected to support us. People, corporates, and sometimes also the money lenders. So in the end, most of the risk, most of the protection gap ends up back with the taxpayer, us, each and every single one of us. Part of the gap are risks that are entirely uninsured. Part of the gap is risks that are insured but have Nat Cat excluded, whether the insured knows it or not. And part of the gap comes from risks which are insured, which have Cat cover, but where the Cat cover is very restrictive. This is coming again to the California example, one of the reasons that most Californians give for not taking up earthquake insurance. They say, well, if I'm going to have a 20% deductible, by the time the deductible is exhausted, anyway, I have a total loss. I don't want to pay for an insurance that will only work if I have a total loss. I don't know how reasonable that position is, but I understand it. Now, how do we close the protection gap? As I said, there are many different levels of risk. Some is with the government, some is with businesses, some is with individuals, and there are different risk transfer solutions. If we're thinking about the macro level for governments, there are solutions to transfer risk that go directly in that direction. And here we can think about pools, we can think about cat bonds, we can think about many different forms of insurance for the public. If we're thinking about the business owners, homeowners, and farmers, traditional insurance is the most likely tool to help. And finally, if we're thinking about individuals, in many spaces, microinsurance is the way to go. And when thinking about microinsurance, let's be careful not to expect this to be an NGO type of thing. Microinsurance can be a very good business for the industry with a very good business purpose. It doesn't have to be corporate responsibility doing microinsurance. It simply means doing the insurance for these simplified products via aggregators. We have a very successful case in Australia where we are selling what is deemed as microinsurance. When you look at the amount of the premium that people pay, I wouldn't really call it microinsurance because it comes very close to what I pay for my renter's insurance in Zurich. But it is a product that is designed to fit the needs of a certain segment of the population. Now, what are the 6 factors that influence insurance penetration? And now I want to make the link to the topic of today, which is closer to technology. I want us to think about what Swiss Re believes are 6 of the key factors that influence insurance penetration, in particular for NatCat insurance. And where can technology play a role in actually changing this? The first one is the share of buyers which are sufficiently risk-aware. If I don't know that I live in an area where there can be an earthquake or where it can be flooded, it is very unlikely that I will find any need to protect myself against this risk. And in reality, most of us will not get to see a 1 in 100 earthquake. I am Mexican, I grew up in Mexico City, and I barely remember the 1985 earthquake. And that was not a 1 in 100 year event. Most of the millennials in Mexico have never been through an earthquake. There have been shakings, because in Mexico City it shakes every Tuesday. But nothing that can be really called an earthquake. How can we expect them to feel the need to go out and buy an earthquake insurance for their house once they are able to afford a house? And here is one of the places where technology can play a role. Technology can help us create awareness by simple things like a calculator showing the likelihood of making a loss of a certain degree in your house through the next 25 years, which is the period of your mortgage. It can help us by creating simulators. Something like, there was a beautiful idea of you picking up your phone and going with your camera and looking at your house and seeing how would it look after a big flood, or how would it look after an earthquake. These kind of things are the spaces where technology can actually help us develop some awareness. A second factor is the share of buyers who trust insurance more than governments or social networks. This is a big one. And this has 2 components. On the one hand side is this charity risk, the fact that I expect the government to take care of me after the event. And honestly, why would I buy something if I can get it for free? It doesn't make any sense. So that is one of the aspects, the trust or the expectation of the government support. But on the other hand is the trust in insurers. Someone already said it this morning, we don't really have a very good reputation. And if we don't have a good reputation, we cannot expect people to come and buy from us. And here I think that we have a partial role from from technology. Technology can help us increase our profile, improve our profile, but it is also a fact that through technology, any bad experience gets multiplied virally. So we need to be very careful in how we handle our client interactions in this modern era if we really want to make sure that our customers end up wanting to buy from us. The next one is the share of buyers that know about and understand available insurance products. It is not uncommon for the customers not to know what is actually covered in their policies. I am an actuary. I have been working in reinsurance for 13 years, and I still have trouble understanding my homeowner's policy and whether something is covered or not. And then you just see that your living room is flooded. And then you need to start asking yourself, where did the water come from? Did it come from the window? Did it come through the hole in the roof? Did it come from a hole in the basement? Just to know in which of the sections of my homeowner's policy can I put the claim. And I oftentimes don't understand that. How can I expect an average consumer to be comfortable with the coverage of their policy? We need to make sure that we have much simpler products that allow our customers to actually feel the value of insurance. And here, again, technology can help us on both sides. On the one hand side, in explaining better what is it that is covered, but on the other hand, it also should allow insurers to have a much more fine view in terms of risk assessment, and therefore in expanding the boundaries of insurability, allowing us to provide much more comprehensive coverage to our clients. And this goes hand in hand with the next one. The share of buyers who believe the product adequately covers their protection need. There are some features such as sub-limits, limits, self-retentions, which can help widen the boundaries of insurability, but which, in the consumer side, reduces the value of the insurance. It is not uncommon to listen to the comments of people saying, well, you know, I have paid for my insurance for 10 years, and the only time that I actually had a claim, they wouldn't pay. And probably it was a very fair claim rejection, in all likelihood. But to the consumer, that is not the key driver. The key driver is I have been paying, and the only time that I wanted the service, it was not there. From the behavioral economics perspective, it would be so much better to charge the insured twice as much at the beginning, but then actually pay the claim, than to give them 50% discount and then run a risk of not paying this one single claim. That's from the behavioral economics perspective. And there are many examples like this that would allow us to increase so much the perception of value in this price to value equation, which is the one that is not working currently. Here, unfortunately, technology doesn't really play much of a role. Share of buyers who find the effort to purchase the product is acceptable. If I need to go through many hoops in order to get a policy, it's much less likely that I will bind it. Particularly currently with millennials. We want to have everything now. I want to have it in my phone, and I want to have it now because that's when I want it. And I was reading a few minutes ago that Allianz just bought a big stake in a fintech company to be able to increase their offer in a digital world. And that is super. It's great. I mean, everything we can do in terms of making our distribution channels much more efficient is amazing. But here regulation plays a role. If I have a wonderful distribution channel with a beautiful artificial intelligence assessor that will walk me through the process of buying my insurance on my phone, and then I click a button, and then the insurer needs to print out a policy and stamp it make a wetting signature and send an agent to my house in order to make sure that I have a copy or 2 copies of it and pictures and etc. Because regulation doesn't allow for a policy to be bound without a wetting signature, then all of the advantages are lost. We need to make sure that we're also pushing the regulation side of the equation. So here technology can help. It can help a lot. But we need to make sure that we get that the regulation also at the same level. And finally, which is oftentimes the first thing that people say, well, it's because it's very expensive. So affordability. In terms of affordability, I think technology can also play a role, particularly if we're thinking about all of the frictional costs that come up on insurance. I don't know how many of you would pay $1 for something that is worth 5 cents. If we are running lines of business at 5% loss ratio, that's exactly what we're asking our customers to do. To pay $1 for something that is worth 5 cents. But if I then add all of the distribution cost, administration cost, overheads, etc., probably that's the least that I can charge. Well, maybe technology can help us get leaner in terms of risk assessment, of policy acquisition, of policy admin. Here is where I would expect to see words like blockchain popping up. Maybe through Bitcoin we can get rid of some of the frictional costs of making business, and then make the overhead much smaller, and then get the premium value closer to the expected loss. So how do I see the future of insurance, of property insurance? All parties working together, government, industry, society. We cannot get it through just by saying, well, I want to sell more and I'm going to sell it cheaper. Simple products, simple distributions, simple admin, and simple claims processes. There is not going to be another way to get there. And then, a zero gap. Thank you very much.